Welcome back to the FDIC Money Smart Series module entitled To Your Credit. I'm John Hurley, the Financial Literacy Consultant for the Apache Junction Public Library. In this segment, we'll provide you with an overview of credit. Now, how many of you have ever borrowed money from a bank, a credit union, or a thrift? What was the experience like for you? And based on what you know about credit, which of the following responses would a financial professional use to define credit? 1, money given to you that you don't have to pay back. 2, money that you borrow to pay for things that you have to pay back. 3, recognition for a job well done. Or 4, that long scrolling text at the end of a movie.
Well, credit is the ability to borrow money. When you borrow money on credit, you get a loan. You make a promise to pay back the money you borrowed plus interest, which is the extra amount of money a financial institution charges you for letting you use its money. Now, credit can be very useful to you unless you are not careful about the way that you use credit. Now, the type of credit we're going to talk about in this segment is personal or consumer credit. Credit for business or commercial purposes will not be covered in this course, but this class is a good start because how you manage personal credit may impact on whether you can get a business loan in the future. Now, have you ever heard the term good credit? Having good credit means that you make your loan payments on time to repay the money that you owe. If you have good credit, it'll be easier for you to borrow money in the future. Now, why do you think credit is important? Well, it's important for a number of reasons. Number one, it can be useful in times of emergencies. It's sometimes more convenient than carrying large amounts of cash. It allows you to make large purchases for things like a car or a house and pay for them over time. And also, prospective employers, landlords, and insurance companies may look at how well you manage credit. Now, credit is a loan often secured by collateral or a guarantee. Lenders take a risk to lend you money. Therefore, they want to make sure that their money is secure. Collateral is security or an asset that you provide the lender. Giving the lender collateral means that you pledge an asset that you own, like your home, to the lender with your agreement that it'll be the source of repayment in case you cannot repay the loan. In other words, if you don't repay the loan, the credit card company is entitled to get the collateral. Now, we'll use this case. Marvin makes writing desks and sells them for extra money. Now, let's say he wants to borrow $1,000 for a new bandsaw and an electric sander. He obtains a loan from the bank and pledges his existing equipment as collateral. If Marvin does not or cannot pay back the loan, what will the lender probably do? Well, remember that the equipment is collateral for the loan. In this case, the bank would first try to get Marvin to pay back. Now, if he cannot or does not pay back, well, they'll probably repossess his equipment and resell it to pay for the loan. Marvin should also be very careful to pay his loan back and do it on time. Late payments will affect his credit history, and lenders may not want to loan him money in the future. Now, this concludes this segment of the FDIC Money Smart Series, To Your Credit. I'm John Hurley, the Financial Literacy Consultant for the Apache Junction Public Library. Thank you for watching.